So here we are. So we've already started, and we're going to talk about journaling and posting transactions. Again, um, feel free to ask questions. I really do this for your sake and whoever else is watching the video. I'm not quite sure of the questions that you may have. I can only make
I
a
think there's just some confusion regarding the discussion this week around. I think it took a bit to understand, and I know it was pretty straightforward and simple,
Mhm.
but but yeah, no, it took a bit to research.
Okay. Did you get it figured out?
Absolutely, I did reply to the discussion and
Oh,
finished
good.
it.
Okay, I noticed. Noticed only one person up. I think it's about 2 o'clock this afternoon that responded. So that's good.
Be me.
All right. Let's see. Okay. So we're going to talk about the data from. We're going to look at source documents. That's kind of part of what our discussion talked about. Um, Using source documents as a source for our transactions. So that's what we'll look at today. When we'll go through that, and then we'll talk about a trial balance, and we'll look at T accounts and things of that sort. All right. So the flow of data. So if you thought about it in your organization, every transactions are driven by some exchange or some event that has happened, and those events should be memorialized by some document. So if you can go back and think about the types of transactions that happen, for instance, you start a business, and if you start a business, one of the first things you probably would do is put money into that business, and so that transaction, taking money from your personal savings, putting into the savings of the company, could be traced back to some documents that used to do that. In other words, you probably have bank statements that show that, or withdrawal and deposit slips, right? Those kind of things. And so you can use that to get an idea of what the transaction was and help you understand what happened during that event. So we'll talk about source documents as input for our transactions. Um, our process is this then. We get those source documents, and the first thing we do is we enter that into our general journal. So I want you to think of the general journal as a notebook. And in most cases, it is not that. But we can consider it or think of it as a notebook that you, as a business owner, you walk around with it in your hand, and anytime a transaction happens, you just kind of jot down what happened, and so you call it your general journal, almost like uh, a journal in personal in your personal life. If things happen, you just kind of write it down so you can remember. And so think of the general journal that way, that it is the notebook that you're walking around with. You're taking notes and all the activities that have happened within the organization. Later on, after a certain period of time, and what we do in accounting is we do a closing period, and perhaps it could be every 30 days, every end of the month. And if you've worked in retail, you probably heard that before, end of month, right? Or closing or those kind of things. At the end of the period, whether it's the month or the quarter or the year, we will take that journal and we want to make, because we have things, notes that kind of happen all over the place. And there's really the only rhyme or reason to our journal are the chronological dates, the chronological order that these transactions happen in. But if we wanted to try to organize them by, what happened in specific accounts, we would have to do that by posting them to the general ledger. So once we want to get things more organized, we take things from the general journal, we move it to the general ledger. Once we moved everything to the general ledger, what we do is we create a trial balance. And the reason why we do that is to determine if we've made some mistakes or some things are off. And so our trial balance is going to take all of our accounts, right? So the general ledger, all the accounts that are found in the general ledger, we're going to post those. Once we've posted those from the general journal, we'll take them from the general ledger, we'll put them in debit and credits balances, and we'll make sure that all of our transactions are balanced. And that's a good start for us. And so we'll get deeper into what that looks like. But this is just the basic idea of what's happening here. All right, so let's talk about source documents. They trigger the analysis of what happened. In other words, they trigger they let us understand, or the accountant know that, hey, there's some transaction, something has happened that we need to make sure that we keep track of because it has affected at least 2 of our accounts. And so we want to make sure that we have record of that, and we keep track of that. It helps us begin the process of entering transactions into the accounting system. The source documents serve as an objective evidence of business transaction. In other words, did this actually happen? Well, these source documents prove that they did, and they are filed for possible future reference. If we ever need to prove that something happened, or we need to go back and see, did we make a mistake on a transaction, we can go back to those source documents, and they can tell us what happened. So here are some examples of our source documents: check stubs or copies of checks, receipt stubs, copies of receipts, cash register tapes, memos of cash register totals. So that would be typically in things like sales, right? Copies of a sales ticket or a sales invoice issued to a customer or client's purchase invoices received from suppliers. So if you buy something, they'll send you an invoice saying, hey, you purchased this on account, you have to pay us, and this is how much you owe us. So those are examples. Now, that again, that is not even the tip of the iceberg. The type of documents you could have. You could have contracts, you have rental agreements. The list goes on and on of the type of documents, source documents we can have, but those are just some. All right, so now we understand we have our source documents. Let's talk about the chart of accounts for classifying financial information. Now, remember, we talked about last week, or actually week 1, we talked about their assets and their liabilities and their equity accounts, right? And we said that, and we even talked about it last week in our presentation, that there are all kinds of accounts that are in our business. So whatever transactions we do, those transactions will be related to some accounts. So if we purchase a piece of equipment, as we talked about last week, well, one of those accounts affected is the cash account, right? So we use cash to purchase this item. And the other account that's affected is the actual piece of equipment that we purchase. That will recreate a new account. And so our chart of accounts is a listing of all the items, all of the accounts, if you will, that are in our business that we have used in some shape or form to do business throughout the period. So the chart of accounts is in numeric order, and it's used to determine which accounts are affected by a given transaction. So let's see. Let's take a look. Notice here the assets, and this is typically how it works, in most organizations. The assets usually have accounts that start with 1, and so you'll see here you have cash and asset account, accounts receivable, supplies, prepaid, delivery, etc. You go through all of these are our asset accounts or delivery equipment, and so it starts with a 1. So anytime we see an account that starts with a 1, we know it's some kind of asset. It's just a way for us to get the general idea of what type of account was affected in our transactions. Liabilities will start with 2s, right? Accounts payable, etc. The owner's equity accounts will start with 3. Our revenue accounts will start with 4. Our expense accounts will start with 5 and sometimes 6, just depends. Right, and so that's typically what I've seen in most businesses, or many, but I won't say most. The businesses I've come across, I've seen this layout. Right, so typically your asset accounts start with 1, liabilities start with 2, owner's equity 3, revenues with 4, expenses with 5 and 6. All right, Raquel, hopefully you're still there. Any questions about what we've talked about so far?
No, sir.
All right. Now that we understand we have these accounts, and those accounts, by the way, let me go back. Those accounts, all these accounts, 101, 122, they're going to be found in our ledger. Right, we're going to have each one of these accounts, and we'll see all the detail of each one of the accounts in the ledger. So the ledger keeps track of each one of these accounts, and all the things that happen, the debits and the credits against these accounts will be found in our general ledger. Our general journal, as I mentioned earlier, is our notebook. It just is a quick way of us just jotting down every transaction. It's really not an order of account. It's in order. It's chronological order. And so our general ledgers help us organize these accounts and see the detail of each one of them. All right, so just keep that in mind as we go through. Now we're going to journalize our transactions. The journal, again, as I mentioned, it's a day-to-day listing of those transactions. And so as things happen, we just write them down in that general journal. It's to provide a record of all the transactions completed by business. It's commonly referred to as the book of original entry. Why? Because that's what we use just on a day-to-day basis to keep track of transactions. The simplest journal form is a 2-column general journal. The act of entering transactions in the journal is called journalizing. All right. All right. So here's a transaction that happened in this organization. Rohan invested $2,000 in the business on June 1st, 2000. In our case, we'll say 2018. New dated transactions. So let's see what happens here. All right. So first of all, we know that transaction 2 accounts were affected. The cash account, why? Because the organization, the company, the business received $2,000, and it received $2,000 from Maxon here, Rohan Maxon, I guess. And so here we see the 2 accounts that were affected. Remember, our debits equal our credits in this case. And how would that look in our general journal? So how would we write that down? Because normally we don't create we're not writing T accounts all over the place. What we're doing is we're writing down in our journal entry, right? And this is typically happening in the computer, but we're writing this down in our journal. And what would we do? We would say, hey, the first thing is, let's put the date that this happened. Remember, I told you that the general journal is going to be in chronological order. First thing we'll do is we'll put the date. Here's the date. And next, once we put our date, we'll put a description of the account that was affected. Again, remember, at least 2 accounts, and that's why you have 2 here. At least 2 accounts are affected in their transaction. It could be more. In this case, just 2. So we put our transaction, we put our description of that. Next, we'll put the amount. Now notice there's a PR number here. We'll get to that later because it's not for us to do right now. We'll need this later on when we come to the end of the period and we're ready to post to our general ledger. But for now, in our journal, we write down the first account affected by this transaction, cash. And it was a debit, so our cash increased. Remember, debit means left side of the T account, credit means right side of the T account. Anytime assets go up, we debit. Anytime assets go down, we credit. Next, we want to put in our second account. Now notice here, this is important. When we do our journal entries, we always do our debits first. So anytime we do a transaction, debits go first, credits go second. We indent the next. Any credits we have, we indent those. All right, debits are not indented. Credits are. It just helps us get an understanding of this is the debit account and this is the credit account. If we have multiple accounts and there were multiple debits, they would all be flush and they would all go first. And then we'd have our credit accounts, right, indented. So we can take a quick glance and see which accounts are debit accounts and which accounts are credit accounts. All right, so notice here, we put this in our credits, and here's our journal entry. It happened on June 20th, year 2018. I'm sorry, June 1st. I'm sorry, right here. Is that right? June 1st, 2018. It was for cash. The cash was, we received cash, in other words, a debit. And why did we get cash? We got it because of a capital. And then what we would do after that is we just put a quick description of that. Owner's original investment in the business. So the general journal gives us an idea of all the transactions that happen in chronological order. All right, does that make sense?
Yes. Can you consider the general journals pretty much as an acting T? What is it called? T ledgers?
I'm sorry, one more time, as a what?
Our last chapter when we were working on, what's it called? T ledgers?
Oh, T accounts.
T accounts, yes. So
actually, the T accounts are more of the general ledger. The next book we'll look at. So what the general journal does, it has half of a T account, right? It's only showing you one side of the T account.
That's right. Okay, I see that.
Right. So this is just the debit side of the T account, and this is just the credit side. So what it's showing us is, yeah, 2 accounts were affected. Real quickly, what date and what was it? We're going to take this information later and we're going to put it into the general ledger, which does represent the T accounts. Okay.
Okay.
All right. Now, once we've done that, we skip a line just for readability, right? We skip a line so we know that this is a transaction all by itself.
Mhm.
All right, compound entries. Now, here's what I mentioned earlier, that each transaction is at least 2 accounts, but it could be more. A compound entry happens when we have at least 1 or 2 credits or at least 1 or 2 debits, but we have more than 2 total. All right, it could be 3, it could be 4, it could be 6, it could be 7, just depending on how extensive the transaction was. Always, as I mentioned earlier, the debits always come before the credits, and every time we do a journal entry, the debits and the credits must equal each other. So let's take a look. Let's see what we have here. So here's an example of a compound entry on June 25th, 2000, and we'll say 18 for the purpose of this discussion. Rohan purchased a $1,500 scooter for $300 cash and $1,200 on account. Now, Raquel, really quickly, can you see that there are more than 2 accounts that were affected here?
Sorry, I have to take the mute off. Yes, there are
That's
more
okay.
than 2 accounts. A scooter was cash and, of course, accounts.
Yeah, so there's 3 accounts that are affected in this transaction, but it's all one transaction, right? All right.
Correct.
So let's work
So
through.
pretty much
Go ahead.
it decreases credit on the cash, and of course credit, it's minus, hold on, plus, negative, negative, plus, credit on the accounts payable, since it is the reverse on the T ledgers, if that's what you're looking at.
And then the scooter would be what?
It would be an increase in equipment. Rohan purchases a scooter. Yes.
And so that would be what, a debit or a credit here?
It would be plus minus. It's an asset, so it's a debit.
Debit. So how many debits and how many credits should we have in this transaction?
We have 2 debits, 1 credit, 3 accounts affected.
All right. So in this case, here's our debit account, 1,500. So if we have 2 debits, what will be the second debit?
The second debit would be the 2. What do you mean 2 credit? Okay, debit. Let's see, cash. This equipment is an asset, which is a debit.
Yes.
What was the question? Did I?
Yeah. So how many debits? How many credits? You said 2 debits, 1 credit. So which would be our second debit? Here's our first.
1
debit.
credit.
One credit. What would be?
Which would be cash. Sorry, no. 1 credit is cash. The debit would be accounts payable. No, reverse.
All right. So remember
I can't see it. So.
You can't see the. All right. So we have a $1,500 scooter. We paid $300 cash, and we also borrowed $1,200, if you will, on Kazoo, right, to pay for the scooter. In this case, remember our debits and credits need to equal.
Mm-hmm.
So, if we have a $1,500 scooter, how much did we put down? Or how much of that scooter do we own?
$300.
How much do we owe?
Oh, I'm sorry, $1,200.
Yeah, so
on
then
accounts payable.
So then we should have 2 debits, 1 debit and 2 credits.
That's true. Mm-hmm.
All right, so let's see how that looks. Because cash was affected, cash went down, that's a credit, right?
Mm-hmm. Yep.
Delivery equipment went up, that's a debit. But the accounts payable, bills, did they go up or down?
Accounts payable went up, which is a credit.
Yeah, so there's our second credit. So here's what we should do here. There it is. And here, so notice 1 debit, 2 credits. How do we do the journal entry for that? All right. See, notice, what do we do? First, the debits are always first, 1,500. And then our next accounts payable. And in this case, they're putting them in order, size order, right?
Yeah.
You don't necessarily have to do that, but it makes it look cleaner. Right?
Okay, usually I see that spaced out from what I saw at the book. So it would be delivery equipment with an explanation, then a space, accounts payable with an explanation, then a space.
Well, that might be a little too much. So what you probably want to do is keep these all clumped together.
Because it's one transaction.
One transaction, absolutely. Because if you do that, people might think, well, hey, is there 3 transactions going on here? All right, so you keep them all together. They can see very quickly debits equal to credits. This is one transaction.
See, I haven't seen that in the book, but okay, got it.
Okay, but yeah, that's how we should look at it. Right? We should keep it together, give it as much readability as possible. That's the key here with these journal entries. All right.
Got it.
So we can quickly see what happened, what accounts were affected, and what is it actually that happened here. Okay. All right.
Got it. Got it.
Now, all right. Now let's talk about you mentioned those T accounts. Here's where the T accounts come into play, the general ledger. If you will, the general ledger is a listing of all the T accounts. All right. So let's see how that works. It is a complete set of all accounts used by the business. In other words, as I mentioned earlier, it's like a listing of all of our T accounts. It's used to keep a complete record of debits and credits made to each account, right? That's just like a T account. Numbered and arranged in the same order as a chart of accounts. And what? There you go. As you asked earlier, similar to T accounts. Okay?
Okay. Got it.
The process of copying debits and credits from the journal to the ledger account is called posting.
Okay.
All right? And it's done, you can do it daily or you can do it on frequent intervals. Sometimes people do it monthly, quarterly. And it's a 5-step process. So what does it look like? Okay, so here we are. Let's go back to that first transaction we had. All right, so this is in our general ledger. What we want to do is we want to take this information and put it into its T accounts. How do we do that? Well, we post it. Well, how does that work? Well, first, we have to find those accounts. Let's go, and we can go through it just in chronological order. Here we have a cash debit. Well, we know that we have a cash account. Remember I told you that PR we were going to come back to later?
Yes, those PRs are pretty much the location of the transaction on the journal page. So it'd be journal page 1. Am I right?
Yeah, you're hitting in the right place. Absolutely. Let's take a look and see what happens here. All right, so we have in the general ledger a cash account, right? And so
yes.
moving from the general journal to the general ledger, we notice that we have a cash account. And notice in that account, and we'll think of this as just one page in the ledger or a book. In the old days, it used to be a really big book, right? It was an actual physical book. It was big. You open it up and you look for the page that said cash on it. And the account number was right there in the corner. You wrote the date of the transaction, right? You put whatever it was, and you would cross-reference, right, the general ledger and the general journal through this PR, and we put whatever, if it was a debit, what happened. And when we're done, we put whatever that balance is, just like we did with our T accounts. Let's take a look at this. Step 1, we're going to record the date. Whatever happened on this date, June 1, and it was a debit. And then what next?
Moving on to the credit.
We move it over, right? Because this is the only thing we have here. So this is our running balance. Remember on the T account, we footed everything. We wanted to find out what's the right. We do it right here. Here's our footing, right? If this were a credit, then this balance would decrease, right? Right now, this number tells us what's our running balance at the time. Okay?
Yes.
There you go. You mentioned earlier, there's that PR. Was that J4? It represents the journal. At which page of the journal? Page 1. So if we ever need to go back and try to find out what happened, we know how to get there. Okay?
Yep.
We come back, right? And what happened here in our PR? What are we doing here with the PR? We're saying, hey, here is what? That's the account. Right? So we go back and we only do this after posting. We don't do it before we post. And the reason why is because we use this to help us understand where we at in the process. If we were to put this and we had not posted to the general ledger yet, we'd be pretty confused. So we only do this after we post it to the ledger to let us know this has been posted. This is a done deal. Okay?
Yep.
Once we've done our posting, we posted to all the accounts. Everything from the ledger has been posted. I'm sorry, everything from the general journal has been posted to the ledger. Now what we would do is we would create a trial balance. When the reason why we're doing the trial balance is because for three things, we want to make sure that our debits and our credits are equal, right? We also want to create weekly or monthly or whatever, we're going to actually begin to look at doing our financial statements. And we'll need to do this first before we do them because we want to make sure our information is right. We do this after all of our transactions have been generalized and posted. Okay, so what's happening here? Here is an example of a trial balance. What do? We went through every account in our general ledger and we stuck them in, right, into this trial balance. Notice there. Let's look at the parts of the trial balance. First column are all of the accounts from the general ledger. Every single one of them are here. Second column are the account numbers, right? We're just going to label them out so we know these are asset, right? Here are liabilities, here owner's equity, revenues, expenses, right? And so we list these in their number order, okay? Next, what we'll do is we'll take whatever the balance is in that T account. If it's a debit balance, we put it in the left hand or the debit column. If it's a credit balance, we put it in the credit column. Now, how will we know if it's a debit or a credit balance? Now, remember when we go back, let's go back to the ledger. That's why this is important. Right here, this will tell us this amount, whatever it is, and we could have a gazillion entries here, right? We could have tons of them. Well, as we're going along, we're keeping track, and so this number, whatever that number is, the last one, should be the amount, and whether it's a debit amount or a credit amount depends, and that tells us where to put it in our trial balance. In this case, cash had a $2,000 debit balance in this case. So when we go to post it. Now, in this case, it's actually a different number. But we must have did some more transactions. And so whatever those transactions were, they added up to having us a balance of $370 in our cash. And so we'll do that. We'll go back to each one of those general ledger accounts, and we will put whatever that ending balance is. When we're done, they should equal each other. All right, that's what should happen. If they don't, either our math was wrong here, or something was wrong with our transactions. And we have to go back, and that's why it's important. You have to go back and say, all right, so when we posted, all right, so I'd have to go back and look at each one of those journal entries. Where did I go wrong? Was everything done correctly when I posted? Did I make sure that I balance all my transactions when I did them? All right. Did I put the right accounts in when I did my entries? All right, so that helps us go back and create and fix errors if they exist. And that leads us to the objective 6. Explain how to find and correct errors. Any questions so far from what we talked about? Journalizing, general posting, trial balance.
No.
All right. So let's take a look. How do we work through trying to find errors if they are there? Notice here, you take a quick look at the bottom. First thing you'll see is that the debits do not equal the credits. What happened? Well, we can go back and check our math first. That might hopefully that we just added something wrong. And so the first thing we'll do, if there's anything too small to relative to the accounts, if there's anything that we entered in the wrong column, put it in the wrong place, was something a debit that should have been a credit, we put it in the wrong place. Right, we check that first. We'll find a difference. What is the difference between the debits and the credits? Is it off by 100? Is it off by 200? Why are they different? And you can divide the difference by 2. Is this number the amount of a specific transaction? In other words, did we double it? Right? Maybe we did something twice, and we should not have. We can divide the difference by 9. If the difference is evenly divided by 9, you could have a slide error or a transposition error. In other words, you put numbers in the wrong place. And instead of 89, you put 98. And by dividing by 9, you might be able to find that. Slide errors occur when the decimal point slid a digit or 2 to the right or the left. So if the amount was 250, but we recorded as 25. Right? The difference is 225. The difference is evenly divisible by 9, right? So if you had a slide problem, you can find, and again, remember, we have to find out whatever the difference is between debits and credits. We divide that number by 9 to see if was this a slide issue. transposition error, right? If the amount was 250, but we recorded as 520, the difference is 270. We divide that difference by the 9. That should tell us, hi, I may have that kind of error. Okay. If steps 1 and 2 don't work, you have to go back, double check your addition in the ledger accounts, and then you have to trace those postings. As I mentioned earlier, you might have to go back and look at every single one of those postings to see if you did something wrong. And that's why those notes that are breadcrumbs that we leave behind in the journal ledger and in the journal are helpful. We use 2 methods: the ruling method or the correcting entry method. Erasing is not acceptable. It may suggest that you're trying to hide something. Used for 2 types of errors: the ruling method, when an incorrect journal entry has been made but not yet posted. All right, so if we made an entry that's not correct, we haven't posted it, we can use this method. And when a proper entry has been made but posted to the wrong account, we can do this as well. So what do we do? Well, let's say an entertainment expense was incorrect in this case. And what are we doing here? What should have been a wage expense, not an entertainment expense? And here, this should have been $200, not 20, and this should have been 200. So notice what we're doing. We're scratching out and putting over it. Notice that in the text it says "do not erase" and "do not use whiteout." That is a flag, a red flag for any auditor or any person who's looking deeper into your information to find out why was this erased. So you probably have done this before. You scratch out things, put your initial over it. Same idea here. That's what's happening, right? Scratch out initial to say, yeah, we made a mistake. Okay, make sense? All right, so correcting an entry. Used when an incorrect entry has been journalized and posted to the wrong account. A new entry must be made to correct the accounts. So assume that a $400 payment for rent was incorrectly debited to repair. Right? Wrong place. It's a repair expense, but correctly credited to cash. So one account was right, one account was not right. I need to get $400 out of repair expense and into expense. Right? Cash is okay. It's just the expense account is incorrect. So what do? Put the $400 spent on the rent into a proper account. Notice here, what do? We reversed. Typically, remember I told you expenses are always debits. So in order to get the amount out of there, I just credit that account. And what that's going to do is effectively make it zero. And so in this case, and we should probably put a note here saying the reason why we did this is because we had something in the wrong place. To correct the error, which payment was for rent was debited to repair expenses, put in the wrong place.
Mm-hmm.
Go ahead.
Speaking of that, the last correction that you made, we did make those corrections on the wages, but there wasn't a note on the corrections. So the 20 to the 200 wages expense versus entertainment, you didn't adjust the explanation below. Paid premium for 8 months, paid employees, those were never adjusted.
Yeah, so let's see, look a little further and see why. Okay.
Mm-hmm.
And I think in this case, I'm not sure if we posted yet or not, but let's go forward. Let's see. All right. And now we go to the rent expense account. Let's see. Let's go back. We go to rent expense account. We put the correct entry in. Notice here what happens to the repair expense. What do? We say it's a correcting entry. And what do? We credit that amount. So in effect, we just zero it out by just doing a credit to the account.
Oh, I see. Okay, you zero it out.
Mm-hmm.
Got it. Okay.
All right. That's it. I think in the other case, if we that's probably an example where we had not posted yet. So if we've not posted yet, there's no need to make those kind of corrections.
Oh, understandable.
Okay. All right. That's pretty much the slideshow for chapter 4. That's in a nutshell. And so hopefully that helps you a little bit more with the discussion question, right? Selecting a source documents, describing the accounts affected by your transaction, giving it an overall description of what actually happened, right? And giving the account numbers that were affected. That's really all I wanted you to do. And just come up with your own transaction for the week. All right.
I completely copied yours.
You have to do your own. Okay.
I'm kidding. I'm kidding. I did leave an explanation out of it. Yes.
Okay.
Got it. All right. Same time, same bat channel.
Next week I may have to do a different day. Wednesday is I did these first couple of Wednesdays because things were kind of slow. I may have to change the date. So I will let everybody know if I change the date. I'll let you guys know what that date is.
Can it be added to the calendar? I see that you can send a message stating the request for the Zoom, but can you add it to the calendar, which shows on the calendar for the students?
You know, actually, I didn't know about that. That's something that I have to figure out. So if I can, I will. If I can, I will. Okay.
Yes, thank you.